Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Paramount stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 7.5 billion market cap. They're trading at $10.47 a share, and they have 713 million shares outstanding. Paramount is a media, streaming, and entertainment company. It operates through TV media, direct-to-consumer, and filmed entertainment segments. The TV media segment operates CBS television network, Paramount Plus, Showtime, MTV, Comedy Central, Nickelodeon, BET, and many more. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a lot of free cash flow in 2022, $600 million. Only a 2% margin. Then it was negative in 2023, back to positive in 2024. Then it blew up over $900 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. $4.5 billion in 2022, nice margin, 16%. Then down 76% in 2023 to $1.1 billion. A small negative in 2024, a big negative in the trailing 12 months, likely from a goodwill impairment. Revenue is a sales for the company, and that grew 5% from 22 to 23, but down after that. It's down about 2 or 3%. What's going on? They do pay a 2% dividend yield, which they can cover 6 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's $16 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $13 billion. We divide that by 700 million shares. And we got a calculated stock price of $18. They're trading at $10. They're trading at a 41% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. Simply Wall Street is at $23 a share. They say they're 54% undervalued. 22 analysts priced this stock at $13. They also say it's undervalued. There are 42 companies in the same industry as Paramount, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend about the average in CapEx, $288 million. Debt to equity ratio of 1. That means for every dollar of equity, they have $1 of debt. Their yield is a little below 2%. They generate a lot of free cash flow, more than News Corp, Warner, Roku, TKO, and Endeavor. Also more than Live Nation, and all those companies have a higher market cap. Paramount is ranked 12th in market cap, $7.5 billion. They have the best price to book. This means they're worth more in bankruptcy than as an operating entity. Can't look at that PE, negative earnings. Price to free cash flow is great. They're trading at 8 times free cash flow, and they have the best price to sales, 0.3. They generate the 4th most revenue, $29 billion, but their revenue is declining. It's going down 3% on average the past 5 years. Here's their latest income statement, the second quarter of 23, second quarter of 24. Revenue is down from 7.6 billion to 6.8 billion. Expenses are almost double their revenue, 12.1 billion of expenses, mainly from this big asset impairment. If you take that away, then expenses are a little less than revenue. When a company has a big impairment, it's probably a goodwill impairment. When they write down the value of something they purchased in the past, a company they purchased, they decrease the value on their balance sheet and pass through a loss onto the income statement. So they have an operating loss of 5 billion, 200 million of interest they paid. So a net loss of 5.4 billion. Last year was a net loss of 300 million. And they're adding shares. Last year, 650 million shares, now 667 million. So to summarize, I have them trading at a 41% discount, ranking a 4 out of 10. Would I buy them 3 out of 10? Even though they look undervalued according to some of their price multiples, I get a bit concerned when a company's revenue has been declining. Really good ratios, 8 out of 10. Amazing price to free cash flow. Financials, 4 out of 10. Even though free cash flow is strong, their revenue has been declining the past couple of years. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.